Hi, I'm Lango, and this is Investor Place Quick Picks, where we communicate to you some of the market's best investment ideas in just 10 minutes.
America's leading innovation investor, Luke Lango's Investor Place Quick Picks.
Today, we're going to talk about an influencer marketing company by the name of IZEA, ticker IZEA. Now, as many of you know, IZEA is one of my favorite small cap growth stocks, which I've been bullish on ever since it was a penny stock trading below $1. The stock has since roared to above $7 and dropped all the way back to $2. Still up nicely from $1, but well off its early 2021 highs. So what gives? Well, you have the growth sector meltdown for one thing, not good for a growth stock like IZEA, but more importantly, you had a bad earnings report last week that missed expectations across the board. Now, admittedly, that report was not great. The SaaS business is not ramping like bulls hoped it would. There are some odd discrepancies between this huge booking growths and much more moderate revenue growth. And current shareholders are going to be diluted by a new $100 million shelf offering to be completed over the next 3 years. None of that's great news. But the big picture fundamentals of IZEA, turning into a technology titan of the multi-billion-dollar influencer marketing industry, remain intact. And therefore, this big drop in IZEA stock is an opportunity for long-term investors. I continue to believe shares have a pathway toward $14 over the next few years as the business scales. So, if time is on your side, it may be a good idea to buy IZEA stock. There are really 4 big reasons behind the post-earnings collapse in IZEA stock. First, the company missed on earnings and revenues. In this environment, growth stocks are being punished even after they smash revenue and earnings estimates. So a double miss from IZEA, it's not good at all. Second, the SaaS business is progressing at a snail's pace. One of the big elements of the IZEA bull thesis was the ramp of its new influencer marketplace, Shake. But while management did say that Shake grew revenues sequentially in Q1, those revenues remain almost inconsequentially small. And the broader SaaS business continues to decline. Also, not great news, especially because the SaaS business represents the scalable future of IZEA. Now, third, revenue growth is lagging. You see, bookings growth was 47% in Q4, 128% in Q1, and will run north of 100% again in Q2. Yet, against the backdrop of that triple-digit bookings growth, revenues rose just 13% in Q1. Management is chalking this up to the fact that bookings are realized over a 3 to 9 month period, and therefore revenue growth lags bookings growth. Makes sense. But the 3-year guide is for greater than 30% annualized revenue growth, which, while an at least number, still seems pretty low for a company doing triple-digit bookings growth. Okay, so fourth, shareholders gonna get diluted. Management is rightly focused on growing as quickly as they can over the next few years to capitalize on the enormous opportunity in front of the company. Big growth requires big funds. And so IZEA filed for a $100 million shelf offering, which could potentially lead to the issuance of 40 million new shares. The current share count is about 60 million. So there is a huge risk that the share count could almost double over the next 3 years. Now, we think investors need to see the forest of the trees here, and once they do, they'll realize that the drop in IZEA stock is an opportunity. The SaaS business is taking longer to rebuild than expected, but management is doing everything right today, from hiring more engineers to expanding its sales team to launching platform updates to marketing Shake to accelerate growth in this business. Plus, the company is sitting on $65 million in cash on the balance sheet to throw at ramping the SaaS business. With time, we fully expect IZEA's suite of software offerings to improve, gain traction, and grow rather quickly. Meanwhile, our historical analysis does show that bookings growth is a leading indicator of revenue growth. Bookings just started to really pick up steam in the last 3 months of 2020 and didn't accelerate to triple-digit growth until Q1. As such, Q1 revenue growth rates shouldn't be that big. The big growth rates will materialize in Q2, Q3, and Q4. And yes, management didn't want to budge on its 3-year 30% revenue growth per year guide, but this is an under-promise, over-deliver situation. Management made it very clear on the call that they established those targets at the end of last year, when bookings were rising by less than 50%. But 5 months later, bookings have been steadily rising at 100% plus pace every single month. It seems pretty clear that revenue growth this year will be well in excess of that 30% target, and that if current business momentum persists, it will far surpass 30% into 2022 and 2023. Now, given this, we actually think that management will crush its 3-year revenue guide and grow revenues by around 50% per year into 2023, not 30%. So, all in all, we think the headwinds knocking down IZEA stock are short-term and narrow. The tailwinds, meanwhile, are enduring and pervasive. That is a great buy the dip combination. Now, our modeling suggests that IZEA stock has a pathway to $14 over the next few years. This price target assumes that influencer marketing continues to grow as a percent of marketing budgets, with the majority of growth driven by micro-influencers, or smaller influencers with less reach but more impact. It also assumes that IZEA's managed services business continues to grow at a very healthy pace, and that Shake and IZEA X start to gain significant traction and turn into meaningfully large revenue drivers. Plus, it assumes stable gross margins and positive operating leverage through economies of scale. Those are admittedly aggressive assumptions, but not unreasonable, given the powerful tailwinds underlying the shift toward influencer marketing and IZEA's robust business momentum today. As such, we think it's time to buy the dip in IZEA stock. Well, that's all we have for this edition of Investor Plays Quick Picks. I hope you liked what you saw. If you did, please subscribe, hit the notification bell, smash the like button, or if you want more research, check out our paid products in the link below. Until next time, cheers and happy investing.